Hey everyone, and welcome back to Talk Tickers. Today we are going to do a deep dive into Marathon Petroleum's Q4 2024 earnings call.
Yeah, it looks like they had a pretty good year overall.
Yeah, they did. They closed out 2024 strong, exceeding expectations in safety and environmental performance.
And the financials were definitely nothing to sneeze at either.
Right. And speaking of financials, they reported adjusted earnings per share of $0.77 for the quarter.
Which brought the full year adjusted EPS to a whopping $9.51 thought.
Yeah, I mean, those are some solid numbers, especially given the volatility we've been seeing in the refining sector.
For sure. And a big part of that success came from their refining and marketing segment.
Right. They had an adjusted EBITDA per barrel of $5.33 for the year.
And they were running at a 92% utilization rate.
Which is pretty impressive. It shows they were really maximizing their capacity.
Absolutely. And it wasn't just refining that contributed to their success.
Oh, yeah. What else was there?
Their midstream segment also had a strong showing.
Midstream being primarily managed by MPLX.
Right. Marathon Petroleum Logistics, they saw a 6% year-over-year increase in adjusted EBITDA.
That steady growth from MPLX is really important because it allows them to increase distributions to Marathon Petroleum.
Exactly, which in turn helps fuel those shareholder returns.
Speaking of shareholder returns, they returned a massive $10.2 billion to shareholders in 2024.
Yeah, that translates to a 23% capital return yield. Pretty impressive.
It really shows their commitment to delivering value back to their investors.
Now, looking ahead, they seem quite optimistic about the future, particularly when it comes to refining.
Oh, really? In what way?
Well, they're anticipating record product demand in 2025.
Record demand. What's driving that?
A couple of things. They're expecting steady demand for gasoline and diesel.
Okay, that makes sense.
But on top of that, they are seeing a big surge in jet fuel demand.
Which is a good sign for the travel industry, for sure.
Absolutely. And what's interesting is how they're positioned to capture this growth.
Oh, how so?
They've got this geographically diversified refining system.
Geographically diversified.
Yeah, so they have assets all across the Gulf Coast, the Midcontinent, and the West Coast.
So that gives them a lot of flexibility.
Right. They can tap into different markets depending on the demand and pricing dynamics.
Makes sense to me.
Now, of course, we can't talk about refining without addressing refining margins.
Yeah, the fourth quarter was a bit of a roller coaster.
True, but Marathon Petroleum is expecting those margins to improve in the second half of the year.
What makes them so confident?
Well, they believe that refinery closures will offset the recent capacity additions we've seen.
So they're banking on a bit of industry consolidation to help boost those margins.
It seems so. And they're also pretty bullish on the long-term strength of U.S. refining in general.
Why is that?
Mainly because of the availability of low-cost energy here in the States.
Makes sense. That gives them a competitive edge.
For sure. And speaking of staying competitive, they're also investing in some major multi-year projects.
Yeah, we touched on that earlier. What are those projects again?
So there are three main ones. The first is a distillate hydrotreater project at their Galveston Bay facility.
Yeah, okay, and remind me again, what does a distillate hydrotreater do?
It's basically designed to enhance their ability to produce ultra-low sulfur diesel.
Ah, so it's about staying ahead of environmental regulations and catering to that demand for cleaner fuels.
Exactly. Then there's the refinery modernization project in Los Angeles.
LA, that's a big market for them.
It is, and this project is all about making that refinery more reliable, energy efficient, and compliant with emissions standards.
California is known for its strict environmental regulations, so that's crucial.
And then the final project is at their Robinson refinery.
Robinson, what are they doing there?
It's a product flexibility project aimed at boosting their jet fuel production.
To meet that growing demand we talked about earlier.
Precisely.
So it's a mix of increasing capacity, improving efficiency, and staying ahead of the regulatory game. Sounds pretty smart to me.
Yeah, they seem to have a good plan, but I'm guessing these projects aren't exactly cheap.
Yeah, what kind of returns are they expecting on these investments?
They're projecting returns of 20% or greater on all three projects.
Wow, that's impressive, especially in today's environment.
It really speaks to their disciplined approach and their confidence in these opportunities.
So they're not just throwing money at the problem, they're making strategic decisions.
Right. And that brings us to another key part of their strategy, MPLX and their wellhead-to-water approach.
Can you remind us what that means exactly?
Basically, it means they're aiming to build a fully integrated value chain for natural gas liquids.
From the point of extraction all the way to the global market.
Exactly. And they're putting their money where their mouth is with a planned capital investment of $2 billion in 2025.
Wow, that's a significant chunk of change. What's the big focus of this investment?
The centerpiece is a massive Gulf Coast fractionation complex and export terminal project.
Tell me more about that. Sounds huge.
It is. It's a multi-year investment totaling $2.5 billion, and it's designed to connect the Permian Basin to the Gulf Coast.
The Permian Basin being a major oil and gas producing region.
Right. And by connecting it to the Gulf Coast, they gain access to those international markets.
It's like they're building a superhighway for NGLs.
That's a great way to put it. And they're not going it alone either.
Oh, they have a partner.
Yeah, they've partnered with ONEOK for the export terminal and pipeline connectivity.
ONEOK being another big player in the midstream sector.
Right. This partnership brings a lot of expertise and resources to the table.
Smart move partnerships are key in this industry.
For sure. And from a financial standpoint, they're expecting mid-teen returns on this project.
Mid-teen returns, that's pretty attractive for a large-scale infrastructure project.
It is, and it shows their confidence in the project's viability.
So it's a win-win. They expand their infrastructure, boost their earnings, and strengthen their position in the NGL market.
Absolutely. Now, we also can't forget about their overall capital allocation strategy.
They're known for being quite disciplined in this area.
Very much so. They reiterated their commitment to prioritizing sustaining capital.
Sustaining capital, meaning what exactly?
It's the money they use to ensure the smooth operation of their existing assets.
So keeping the lights on, so to speak.
Exactly. And they're also committed to maintaining a secure, competitive, and growing dividend.
Got to keep those investors happy.
Right? Those are their top priorities. But what about any excess capital?
What happens to the leftover cash?
Well, that's where share buybacks come in. They've stated any excess capital will be returned to shareholders through buybacks.
And they've got a pretty sizable authorization for that, don't they?
They do. Currently, they have $7.8 billion remaining under their existing share repurchase authorization.
Wow, that's a lot of firepower for buybacks. It's clear they're serious about returning value to shareholders.
Very serious. But it's not all smooth sailing. There are a few potential challenges on the horizon.
Oh, like what?
Well, for starters, those looming tariffs on Canadian crude imports.
Yeah, those have been making headlines. What's Marathon Petroleum's take on them?
Well, they believe that their integrated system and feedstock flexibility will help mitigate some of the impact.
Meaning they have options. They're not solely reliant on Canadian crude.
Right. They also believe that if those tariffs are implemented, the cost increases will likely be borne by the producers.
And maybe passed on to consumers to some extent.
Yeah. So they're not expecting to shoulder the entire burden themselves.
Okay, that makes sense. But I'm sure there are other challenges too.
Yeah. Another area of uncertainty is renewable diesel.
Renewable diesel has been a hot topic lately.
It has, and the margins have been quite volatile. Plus, there's a lot of flux and government incentives, which adds to the complexity.
Okay, so what are the specific uncertainties they're highlighting?
Well, one big question mark is the 45Z tax credit.
Which is designed to encourage the production of low-carbon fuels.
Right. And the way this credit is implemented could have a big impact on the economics of renewable diesel production.
So it's a wait-and-see situation.
It seems so.
Right.
And then there's the expiration of the biodiesel tax credit to consider as well.
So a lot is riding on how these policy decisions play out.
Absolutely. But despite all this uncertainty, Marathon Petroleum is emphasizing their strategy of optimizing feedstocks to maximize margins.
So they're staying flexible and adaptable.
Exactly. That's key in a dynamic market like this.
Well, that wraps up the first part of our deep dive into Marathon Petroleum's Q4 2024 earnings call.
We covered a lot, but there's still more to come.
Stay tuned for part 2, where we'll delve into the Q&A portion of the call and get those analyst perspectives.
It's going to be a good one. All right, so let's dive into the Q&A portion of the call and see what kind of questions the analysts had.
Yeah, I'm always interested to hear what's on their minds.
So one analyst zeroed in on Marathon's impressive refining margin capture in the fourth quarter.
Impressive in what way?
Well, they achieved a 119% capture rate, which is pretty remarkable.
119%? How's that even possible?
Well, capturing 100% of the benchmark refining margin is considered solid performance, so exceeding that by nearly 20% is noteworthy.
Yeah, that definitely raises an eyebrow, what was driving that outperformance.
Yeah. The analysts wanted to know the same thing. They asked if it was just seasonal factors or something more strategic.
Makes sense. So what did Marathon say?
They acknowledged that seasonality did play a role.
Okay, the fourth quarter typically sees a boost in capture.
Right. But they emphasized that their strategic initiatives were a major factor too.
Interesting. Can you elaborate on those initiatives?
Sure, they highlighted their record-breaking export strategy both in terms of volume and margin capture.
So they're really capitalizing on that global demand.
Exactly. And they also pointed to their strong execution in the asphalt business, which further bolstered their capture rate.
So they're firing on all cylinders.
It seems so. Now, of course, no earnings call would be complete without questions about those looming tariffs on Canadian crude imports.
Right, that's been a hot topic. What were the analyst concerns?
Well, one analyst asked specifically about the potential impact on Marathon.
Yeah. How did they respond to that?
They basically reiterated what we talked about earlier, emphasizing their integrated system and feedstock flexibility.
Right, they have options.
Exactly. And they also reiterated their belief that any cost increases from tariffs would likely be borne by the producers.
Not by Marathon themselves.
Right. And they might even get passed on to consumers to some extent.
So Marathon is not expecting a major hit to their margins.
That seems to be their assessment, but the analysts didn't stop there.
Oh, what else did they ask?
They also asked about the potential for utilization reductions if Marathon had to shift away from those heavier Canadian crudes.
That's a valid question. Refineries are optimized to process specific types of crude.
Right. So shifting away from those heavier crudes could mean operational adjustments.
What did Marathon say about that?
They acknowledged that yield shifts and potential utilization impacts were possible, but they were quick to point out that the market would likely respond swiftly to absorb any excess heavy barrels.
So they're not anticipating a major disruption to the supply and demand balance.
It seems not. Now, another analyst shifted gears and focused on MPLX and their wellhead-to-water strategy.
Specifically, that massive Gulf Coast fractionation complex and export terminal project.
Right. That $2.5 billion behemoth.
What did the analysts want to know about that?
They were really interested in those mid-teen returns that Marathon is projecting.
They wanted to make sure those numbers weren't just pulled out of thin air?
Exactly. So they asked about the underlying assumptions behind those projections.
So what did Marathon say?
They assured the analysts that they had thoroughly vetted the project.
They didn't just throw darts at a board.
Nope. They considered all the factors, capital expenditures, market dynamics, implementation costs, potential risks.
So they've done their homework.
It seems so. But the analysts had another insightful question.
And what was that?
They asked whether increased capital spending at MPLX would impact Marathon Petroleum's ability to return capital to shareholders.
Oh, that's a sharp observation.
Right, because those distributions from MPLX essentially fund Marathon's dividend and capital expenditures.
So they were wondering if these big growth projects would take away from shareholder returns.
Exactly. And Marathon emphasized that MPLX has a solid balance sheet and plenty of financial flexibility.
So they can fund these projects without impacting those distributions to Marathon Petroleum.
Right. They see it as a win-win. These investments will enhance MPLX's cash flow in the long run.
Which ultimately benefits shareholders.
Precisely. Now, shifting gears again, another analyst focused on the West Coast refining market.
Oh, interesting. What about it?
They pointed out the upcoming closure of another refinery and some unplanned downtime in the region.
Which could create a tighter supply-demand balance.
Right. So the analyst was curious about Marathon's view on the long-term viability of their West Coast assets.
Yeah, given those closures and California's strict regulatory environment.
Exactly. So what did Marathon say?
Well, they acknowledged the challenges, but reiterated their belief that their Los Angeles refinery remains competitive.
They highlighted its integrated nature and its feedstock flexibility.
So they can adapt to changing conditions.
Right. They also emphasized their ongoing investments to enhance the refinery's efficiency and meet those tough environmental regulations.
They're not giving up on California.
It seems not. But the questions kept coming. Another analyst turned their attention to renewable diesel margins.
Of course, those have been all over the map lately.
Exactly. And the analyst was interested in Marathon's outlook for early 2025.
Given the implementation of that 45Z tax credit.
Right. The details of that credit are still a bit unclear.
So Marathon had to navigate those uncertainties.
They did. But they expressed confidence in their Martinez renewable diesel facility's ability to generate positive EBITDA.
So even with the uncertainties, they believe they can still be profitable.
That's the message. They also emphasized their focus on those low carbon intensity feedstocks.
Which aligns with the 45Z incentives.
Precisely. Now, remember earlier we talked about Marathon's record product exports?
Yeah, that was pretty impressive.
Well, one analyst picked up on that and asked about the demand trends they're seeing.
Both domestically and internationally.
Right. They wanted to know where the growth is coming from and if there are any notable differences between gasoline and diesel demand.
So what did Marathon say?
They highlighted strong demand signals from Latin America and Europe,
Interesting.
particularly for gasoline exports.
Any insights into why those regions are seeing such strong demand?
Marathon didn't get into specifics, but it's likely a combination of economic recovery and increased travel.
Makes sense.
They also noted that diesel demand has been relatively steady, while gasoline export demand has seen a significant uplift.
So it's not just a rebound effect, it's a notable shift in demand patterns.
That seems to be the case. Now, back to renewable diesel for a moment. Another analyst focused on the potential impact of that 45Z tax credit on Marathon's feedstock strategy.
Makes sense, as we discussed, the structure of that credit could influence the types of feedstocks they use.
Right. The analyst specifically asked about vegetable oils and imported used cooking oil.
Those are popular feedstocks for renewable diesel.
They are, and Marathon emphasized their commitment to maximizing the use of low carbon intensity feedstocks.
Which aligns with the 45Z.
Exactly. They also highlighted their partnership with Nest at the Martinez facility.
Nestor, they're a big player in renewable fuels.
They are, and this partnership gives Marathon access to Neste's expertise in feedstock optimization.
It seems like a smart move.
Definitely. So as you can see, the Q&A portion of this earnings call was pretty comprehensive.
We covered a lot of ground, from refining margins and strategic investments to potential headwinds from tariffs and the evolving landscape of renewable diesel.
Yeah, it was a whirlwind of information.
Welcome back to Talk Tickers. It's time to wrap up our deep dive into Marathon Petroleum's Q4 2024 earnings call.
It feels like we've been through a lot.
Yeah, we've covered so much ground, from their strong financials to those looming challenges.
And everything in between.
So as we bring this analysis to a close, what are the key takeaways for investors?
I think the biggest takeaway is that Marathon Petroleum is a cash flow machine.
Yeah, their refining and marketing segment is doing really well.
And their midstream business with MPLX is continuing to grow.
And on top of that, they're returning a ton of value to shareholders.
That's right. That 23% capital return yield speaks volumes.
It shows they are serious about rewarding their investors.
And they are also investing in their future to maintain that competitive edge.
Those multi-year projects are no joke.
They are making strategic decisions about where to allocate capital.
But we can't forget about those potential headwinds we discussed.
The Canadian crude import tariffs and the uncertainty surrounding renewable diesel.
Those are definitely worth watching.
But Marathon seems well equipped to handle them.
Their integrated system, their feedstock flexibility, those strategic partnerships.
They give them options.
So what should investors be watching for as we move into 2025?
Number one on my list is those Canadian crude import tariffs.
Will they actually happen? What will the impact be?
It's a wait-and-see situation, but it could be a big deal.
Okay, what else?
The implementation of the 45Z tax credit for renewable diesel.
How will those final details play out?
We'll have to see, but it could be a major factor for renewable diesel economics.
Right, and of course, we can't forget about global energy demand.
Will the demand for gasoline and diesel remain strong?
Will jet fuel demand continue to rise?
All of these factors will impact refining margins and Marathon's profitability.
It's a complex equation.
And one more thing, to watch their capital allocation strategy.
Will they continue with those share buybacks?
Will they increase the dividend?
Will they make any acquisitions or divestitures?
These decisions will tell us a lot about their outlook for the future.
So it seems like Marathon is in a good position, but there are some uncertainties on the horizon.
That's a fair assessment.
But remember, this is just our analysis.
We are not giving financial advice.
Investors need to do their own research and make informed decisions based on their own goals and risk tolerance.
Absolutely. Now, before we wrap up, we can't forget about our "This is not financial advice" segment.
Are you ready to unleash another wild trade idea?
Always ready. So here's a thought. And remember, this is purely hypothetical.
Okay, I'm listening.
What if Marathon Petroleum decides to go all in on shareholder returns and announces a massive special dividend?
A special dividend on top of their regular dividend and buybacks?
Exactly. It would be a huge surprise to the market.
It would definitely get people talking.
Imagine the headlines: Marathon Petroleum showers investors with cash.
Short sellers would be scrambling to cover.
It could trigger a massive short squeeze.
It's a bold idea, but it's not entirely out of the realm of possibility.
They have the cash flow, and they are committed to returning value.
But again, this is just a fun thought experiment.
Not financial advice.
So don't make any investment decisions based on our wild speculation.
Do your own research.
Well, that brings us to the end of our deep dive into Marathon Petroleum's Q4 2024 earnings call.
We covered a lot of information today.
We hope you found this episode informative and engaging.
Until next time, happy investing, everyone.